In Chapter 13, our final chapter, we will be looking at retirement savings and deferred compensation. Specifically, we'll describe the tax and non-tax aspects of employer-provided defined benefit plans from both the employer's and employee's perspective. We'll explain and determine the tax consequences associated with employer-provided defined contribution plans, which include traditional 401k and Roth 401k plans, describe the tax implications of deferred compensation from both the employer's and the employee's perspective, look at the tax consequences of traditional and Roth IRA accounts and explain the difference, describe retirement saving options available to self-employed taxpayers, and the limitations for deductible contributions to retirement accounts for self-employed taxpayers. And then the final area is the Savers tax credit, another tax credit. So let's get started. First of all, employer-provided plans are mentioned a lot throughout taxes. A qualified plan from an employer must not discriminate between employees. Okay, so it can't just be out there for certain employees or high-level employees. The two main types of contribution or plans, the two main types of plans are defined benefits and a defined contribution. So we're going to deal with defined benefit plans first. So these are all retirement plans we're looking at. A defined benefit is when, as an employee, your employer tells you what you're going to get when you retire. They define your benefit at retirement. So it's a standard benefits are based on a fixed formula. It's usually determined by your average compensation, years of service, but the maximum benefit you can receive in 2017 is $250,000 a year. So it's the lesser of what you can receive 100% of the average of the employee's 3 highest years of compensation, or it's maxed out at $215,000. And this is talked about on page 13-3. Employers deduct liability as they contribute to plan. So your employer is funding them, and you may be also. But the key here is that at the end, you know what you're getting when you retire. So somebody needs to tell you and your employer how much needs to be put away now in order to get that benefit that's defined at the end. Employer, not the employee, bears the investment risk, meaning they need to make sure that much money is available to you at retirement. There are different vesting schedules, 5-year cliff or 7-year grade. Now these are explained on page 13-4. First of all, vesting. What the heck is that, right? Vesting is the process of the retirement becoming, or the person becoming, legally entitled to certain rights or property. So a taxpayer vests or becomes entitled to retirement benefits as they meet these requirements. The most restrictive vesting can impose on a qualified benefit plan is either a 5-year cliff or a 7-year graded vesting schedule. Under the cliff, after a certain period of time, benefits vest all at once. So in this case, it would be after 5 years, everything, you have to work there 5 years. And that's what it's the time you're putting in of service. So after you've worked 5 years, you are entitled to all your retirement. A 7-year graded plan, so grading investing, would be you will start becoming legally entitled to retirement benefits um, pr- uh, proportionately or by a certain percentage each year you work. You could see there, the first 2 years you're not legally entitled to anything. The third year, 20% of them, 40% of them, 60, 80, and then when you're done at the end of 7 years, so it's more of a gradual or graded vesting. Okay, so that's the big thing about defined benefit plans. Now, from a contribution standpoint, it's really you and the employer normally. And when you have money taken out of your paycheck to fund that future retirement benefit as it's defined, it is taken out pre-tax, meaning that money is never taxed as you earn it. So non-taxed money is being put away in your retirement, which the employer needs to make sure there's enough money in there when you retire to give you what they defined as your benefit. When you take distributions out of your retirement, it will be taxed as ordinary income. You have no basis in it. There's pre-tax income in there. There's employee benefits that were never taxed to you when your employer put their share in. And then there's earnings on that money that aren't taxed as the retirement plan earns that. So 100% of the distribution is taxable as ordinary income. Now, this next area is talking about if you take the money out or start distribution before the age of 59 and a half and you don't meet an exception reason. Some of the exceptions for early distribution, so you could take your money out without penalty, or you become disabled. You died. You use the money to pay medical expenses or tuition for school. Unless it meets one of these exceptions, not only will you pay an income tax on the distribution, but in addition, a 10% penalty on that. CBA provides a defined benefit plan to its employees. Under the plan, employees earn a benefit equal to 2% for every year of service of their average salary for their 3 highest years of compensation. They implement a 7-year graded vesting schedule as part of the plan. If Tina works for CBA for 4 years and she earns an annual salary of 60, 65, 70, and 75, then leaves work to work for another employer, what benefit would she be entitled to receive, her vested benefit at retirement? Well, the average of her 3 highest salaries are the 65, the 70, the 75. Add them together, divide by 3. What is her benefit percentage? Well, it increases 2% each year for each year of service. So 2% times 4 year, or 8%. So how much is she entitled to at retirement if she worked there the full and was vested 100%? $5,600 a year. Since she's only vested 40%, take 40% of that 100% vested amount. Her vested benefit, what she will actually receive, is $2,240, and it is all taxable. That's how defined benefit plans work. Now, a defined contribution, well, let me just back up. There's not a lot of those left. State employees are the lucky ones, like myself. I'm involved in the Pennsylvania State Employee Retirement Benefit System, and I am very lucky and know I am to be involved in that. And I know how much I will receive when I retire if I put in the appropriate amount of years of service as a teacher at LCC or a state institution. But most people are involved with what's called a defined contribution. A defined contribution plan, you define how much you're putting away. Okay? So you know I'm going to put 10% of my salary away every year for the next 30 years. And whatever's in that retirement plan, when I retire, that's what I'll get. And I'll take it out the way I want. So you're not guaranteed a dollar amount at retirement. So the risk of the investment really falls on you. Employers will typically match anything the employee puts away, or sometimes they'll fund it 100% for you. Depends if you're lucky enough. Employees may contribute to the plan. Again, if they do, it's pre-tax income, and the employer's match or the employer's contribution isn't taxed to the employee when the employer makes it. And the employee chooses how to invest that money because the risk falls on them. These are often called 401k, and that's the normal for out in the business world. 403bs may be more in educational institutions, and off the top of my head, I'm not sure where 457s usually are offered, but they are another type of defined contribution plan. There are limitations on how much an employee can contribute per year to these plans. In 2017, they can contribute up to $18,000 a year if they're under 50. If they're at least 50, that number is $24,000. Overall, how much can go into an employee's defined contribution plan between the employer and the employee? It's limited to the lesser of $54,000 or 100% of the employee's compensation. $60,000 if they're over 50. So there are limitations on how much you can contribute. Before Dave retires at the end of 2017, he continues to contribute to a CBA-sponsored 401k account. CBA matches employee contributions on a 2-for-1 basis up to 4% of the employee's salary. So for every 2, they put $1 in. Dave is 72 years old at the end of the year, and he earned a salary of $490,000 during the year. Dave contributed $24,000 to his 401k account. How much would CBA contribute? $36,000. The maximum they could put away is $60,000 since Dave is over 50 years in total. Since he's already contributed $24,000 of his own money, his employer is only allowed to contribute an additional $36,000. CBA would have contributed $39,200 if there wasn't this limitation. So there are some drawbacks here. When it comes to vesting, employee contributions, so the money they put away, and earnings on it are vested immediately. So the employee has legal rights to those immediately. The employer contributions and earnings on those vest normally. The minimum vesting is a 3-year cliff, so everything vests at once after 3 years of service, or a 6-year graded. And they show you some percentages related to that for the 6-year graded. And it's only the employer contribution and earnings on that would vest. Oh, and there it is. Good. Distributions, again, are all ordinary income. The taxpayer has no basis in it. They were never taxed on their own contributions. They were never taxed on the employer's contributions, and they were never taxed on the earnings within the retirement account. So, if there are early distributions to a 10%, there's a 10% penalty. So, if you're start taking contributions before 59 and a half, and you're still working, or before 55 years old and you're separated from service, so you're not working there anymore, then you're encountering a 10% penalty. Assume that when Lisa is 57 and still employed by CBA, she requests and receives a $60,000 distribution from her 401k. What amount of tax and penalty is Lisa required to pay, assuming she has a marginal tax rate of 33%? Well, she went and took out and still works at the company before she's 59 and a half. So she'll pay income tax of 60,000 times 33%, plus she'll add this, so that'll be 13,800. The penalty for early withdrawal of retirement before 59 and a half and still working of 6,000, $19,800. So you got to be careful of that kind of stuff. They'll whack you. Sometimes retirement plans have a required minimum distribution. When an employee reaches age 70 and a half or retires, if later, and each subsequent year, you must take out a minimum amount of your defined contribution plan. Now you can defer your first required distribution till April 1st of the next year, but subsequent distributions must be made by December 31st of the current year. It's calculated based on the percentage of balance at the end of each prior year. So you have to take out a certain percentage of your retirement each year. You're required by law. If you don't, you get a 50% penalty on the portion you didn't take out and you were supposed to. Assume that Dave retires from CBA in 2017 at 72. Also assume that his 401k account balance was $3,500,000. Whew, that's nice. What is the minimum distribution he must receive for 2017, and when must he receive it? Well, first of all, if he's 72 when he retires, he needs to take out 3.91%, or 92%, I'm sorry, 3.92. And this is from the let me see. Yeah, the table on page 13-10. They're off by a percentage here. They have 3.91 from the table in the book, 3.92 here. But that's okay. 3.5 million of that, of 3.5 million, almost 4% of it, he must withdraw. Now, in that first year after retirement, he has to withdraw by April 1st of 2000 of the next year. Again, contributions made are into a 401k are made before tax. So distributions are all taxed in a traditional 401k. And the 401k gets its name from the code section, Section 4, Internal Revenue Code Section 401, Part K. Sometimes there's Roth 401k plans, though. It's just a different type of 401k. So what we were just looking at is traditional. Contributions to these kind of plans are made after your money has been taxed. So your gross pay is taxed and then the contribution is made. It's not tax deductible, and the employer contributions must go into a traditional 401k plan. Why? Well, you can start receiving qualified distributions for the distributions you made for any of the money in the account after, if you leave it open for 5 years and you've reached 59 and a half. Then you are receiving qualified distributions. Qualified distributions out of the part that you contributed to, plus the earnings, is non-taxable when you distribute it, because that money was already taxed. Non-qualified distributions, the distributions of earnings are taxable. The distributions of earnings are subject to a 10% penalty if you take it out early. And there it is. Distributions from the contributions are not taxable. And I apologize, I was wrong. It's only the contribution part that is not taxable. The earnings on anything is taxable. The part from the traditional 401k that the employer puts in for you because you have a Roth 401k is all taxable. Non-qualified plans. A plan is a non-qualified plan if it discriminates. Only certain high-level employees can participate in it. And these are generally, as I just said, provided to executives or highly compensated rather than the normal rank and file. Can be used to make employees whole when contributions to qualified plans would be limited. So you can use these for highly compensated individuals when they can only put between them and the employer $60,000 away in a 401k and they want to put more away. Okay. Employer deducts for tax purposes when pays the deferred compensation. Employee includes an income when they receive the deferred compensation. And if it's paid after retirement, Code Section M162 does not apply. And this is on page 13-18. Okay, so normally employers are only limited to deducting $1 million in compensation for a highly compensated employee, and that's the 162M limitation. It doesn't apply if the compensation is paid after retirement. So this is another way for employers to pay highly compensated individuals and not be limited. For instance, let's say you have CEO. You pay him $1 million in salary and you put in a non-qualified retirement plan $2 million. You put $2 million away in a non-qualified plan. You deferred the tax on it to a future period by putting that money away now. They're not going to be taxed on the money. It's being put away. They could deduct the $2 million this year, the employer. When the employee gets the money, if it's after retirement, that's the key, then they'll pay the tax on it. So when it comes to these deferred compensation plans, there's a lot of relevant variables between the employer and the employee, both of their current tax rates, future tax rates, the cost of the investment to both. Okay, that's all I really have to say about those. I want to spend the rest of our time really getting into this other major area that people contribute into a lot, and we're looking at common things out there. IRAs. IRAs are individual retirement plans. Individual. Only one person can own an IRA. So you'll never see a husband and wife owning it together. For many years, there's what it was just called IRAs. They were traditional IRAs. We're going to talk about those. And then probably about 20 years ago, 25 years ago now, they came up with a new type of individual retirement account called a Roth IRA. So let's start with the traditional. Individual retirement accounts. If you make contributions to these, you may be able to deduct for AGI the amount of contribution, generally. If you participate, though, in an employer-sponsored retirement plan of any kind, you may not be able to take a deduction for AGI for the contribution. Okay. How much can you deduct if you don't participate in an employer-sponsored plan? The lesser of $5,500 or earned income. So if your earned income is less than $5,500, you can only contribute and deduct $5,500. If you have no earned income, you can't be funding an IRA or deducting it. If you're 50 or older, that number goes up to $6,500. Married taxpayers, the deduction is allowed if they participate in the plan and income is below certain thresholds. You saw on the previous slide, it says if you're single and you participate in an employer plan, you may be able to deduct a contribution. It doesn't limit the dollar amount of your contribution. You can still make up to $5,500 or earned income, but you can only deduct a certain amount, and it would be $65 also. Also, if one of the spouses doesn't work, the other spouse can make the contribution for the spouse who doesn't work, so they don't limit you there. You can make non-deductible contributions. See, the big deal about traditional IRAs when they were in their big heyday was that put money away now that was taxed, deduct it on your tax return as a deduction for AGI. Then when you retire, take the money out and it's all taxable. But because now we may not be able to deduct all of our contribution because we participate in a plan, there's going to be a deductible portion and a non-deductible portion if we're lucky. Maybe none of it will be deductible. So we have to keep that in mind. When does that become a problem? When you take the money out. Because now not all your money will be taxed when you take it out. Because some of your contributions, you never deducted on your tax return when you made the contribution. You can take a deduction on the current year's tax return even if you didn't fund the IRA yet. So you figure out your tax return for 2017 during February of 2018. And you say, what if I contribute $5,500 to my IRA? And you figure out you can deduct all of it. And it's going to be a significant tax savings to you. Well, you can do it. Just make sure you put the money in the IRA by April 15th of 2018. That's what we're talking about there. So you don't have to make the contribution in the tax year, but you have to make it by April 15th of the subsequent tax year. When it comes to IRAs, distributions are taxed as ordinary income normally. Again, there's a 10% penalty if these are made before 59 and a half, except if they're for medical expenses, health insurance, sometimes for your first home. You can withdraw up to $10,000 penalty free. If you take money out for any reason here, even if it meets an exception, you're still paying income tax on it. You're just escaping that 10% penalty. You could take up to $10,000 out of an IRA to purchase your first home. Pay income tax on it, but no penalty. I actually took advantage of that, back when I was 30. 20 years ago, and I was able to do that. You still have to follow minimum distributions rules. My father goes through that now because he loves his IRAs, and he's always like, I got to take my required minimum distribution out. I got to make sure I do that because if I don't, I get penalized. 50%, remember? We also have to figure out if we did not deduct all of our contributions on our tax return as we were making them, the non-taxable percentage of our distribution, that is the non-deductible contributions we made over the years. So of all the contributions we made, how much were we not able to deduct on our tax return because of limitations set up by the tax law? Divide that by the balance of your account. That percentage of your IRA distribution is non-taxable. Non-deductible contributions I'm sorry, I should start. Let me back up a second before we even start talking about Roth IRAs. I'm kind of upset that I didn't see a slide in here and I didn't add one in. I would like you to take a look at page 1321. We talked about, what if I participate in my employer's retirement plan, but I want to have a traditional IRA? If you're married filing joint, this is on page 13-21. Okay. If either spouse, this is under, it's a spousal IRA, go to the next paragraph. If either spouse is an active participant in an employer's retirement plan and they file a joint return, and their AGI is $99,000 or less, they can take a full deduction for their IRA contributions. Not Roth, we're still talking traditional. If their AGI is between 99 and 119, then they phase out the amount they can deduct. How do they do that? Well, they say, how much is my AGI above 99,000? Take that difference, divide it by the range of the phase out, which is 20 grand. So you could see there, they give an example. If the AGI of the taxpayer is 111,000, it starts phasing out at 99. So, and just because it's so late in the day when I'm doing this, I need my calculator. So it's 111, starts phasing out at 99. So that's 12,000. It's over that bottom end of our range. Our range goes from 99 to 119, so that's a $20,000 range. So 60% of the contribution will not be allowed as a deduction. So if you made an $11,000 contribution, $5,500 for yourself, $5,500 for your spouse, of that $11,000 you contributed, you cannot deduct or take as an IRA contribution deduction for AGI on your 1040, $6,600 of it. If your AGI is above 119, you don't get any deduction for your contribution. You can make it, but you don't get a deduction. It goes on to the next scenario. What if only one participates and the other one doesn't? Well, now look at the phase out. There's no phase out if the couple's AGI is equal to or less than 186,000. There's a phase out if it's between 186 and 196, and after 196 you don't get it. Okay, so take a look at those rules on determining the deductible portion of a contribution made to a traditional IRA. Great calculations in the examples on the next page, and post any questions you may have. So let's go to Roth IRAs. Roth IRAs are the newest IRA, and they're really a nice investment vehicle for retirement, especially if you're young. You make contributions into it that are non-deductible, so you cannot take them as a deduction on your tax return. They're made after tax, meaning you must pay tax on that money, if it's from earnings, let's say, and then you make the contribution. You only can deduct contribute up to $5,500 limit, and that $5,500 limit isn't per IRA you own, because you can own a Roth IRA, a traditional IRA. It's an overall limitation of contributions in the aggregate. When your income reaches certain levels, though, it starts phasing out the amount of a contribution you can make to a Roth IRA. Take a look at page 13-23. If you're unmarried and your AGI is 118,000 or less, you can make the full $5,500 contribution. And these are all under the assumption you're less than 50 years old. If your AGI is between 118 and 133, your contribution is now limited So again, you would do the same type of calculation. Let's say your AGI is 130,000 in this scenario. How much of a contribution can you make? Well, take the 130 minus 118. So your AGI is $12,000 over the lower end of the phase out. And this phases out over a $15,000 range from 118 to 133. So 4/5 or 80% is the result. 80% of what? 5,500. So if you take 80% of 5,500, that's how much of a contribution you can't make. You can't make, or 4,400. So if the 5,500 subtract 44, you can make an $1,100 Roth IRA contribution that year. If your AGI is above 133,000 as an unmarried individual, totally phase out. You cannot make a contribution in that year. So those phase outs we talked about with the traditional limit your deduction. You can contribute up to 5,500 in a traditional. Phase outs on Roth IRAs limit your contribution. When you receive a distribution from a Roth IRA, this is the beauty of it. If you leave that money in there for 5 years and then start taking distributions, it's tax-free. Now, if you take money out before the 5 years that it's been sitting there, your contributions you put in are taken out tax-free, but earnings would be taxed. If you leave it in there for at least 5 years, earnings will not be taxed. So it's all tax-free if you follow the rules. So the account must be open for 5 years before you can receive qualified distributions, and you must be at least 59 and a half again to receive them, or you received the distributions because of death, not you, it was sent to a beneficiary, or you became disabled, or again, it's a first home purchase. Those are the only exceptions to that early distribution rule. Non-qualified distributions of earnings, so distributions that were not in there for 5 years that represent the earnings, subject to income tax and a 10% penalty if received before 59 and a half. There's no minimum distribution on Roth IRAs. None. You could take it out whenever you want, whatever amount you want. So some people, when these Roth IRAs came out, said, geez, I really like this idea of a Roth IRA. I think I want to take money from my traditional IRA and put it into a Roth IRA, change it into this different investment vehicle. We call that a rollover. Okay, so why roll it over? Well, it could be because of the point where your marginal tax rates are at. And they talk about it on page 1325. Contribution limits to Roth are effectively higher. There's a $5,500 limit after tax versus before tax. Take a look. Assume when Tina graduated from college, began working for CBA, Tina made a fully deductible $4,000 contribution to a traditional IRA account. 3 years later, when her marginal tax rate is 25%, Tina withdraws the $5,000 balance in the account and contributes, rolls over, $3,750 to a Roth IRA. What amount of taxes and penalty is she required to pay on the rollover? Okay, she must pay $1,250 in taxes, 25% of the $5,000, because she's taking money out. Contributions and earnings. Remember, she deducted the contribution when she made it to the traditional IRA. She was never taxed on the earnings. She withdrew all $5,000. Now's the time to pay the tax. She's also going to have to pay a $125 penalty. The penalty is not because she withdrew all $5,000, but because she never put all 5,000 into the Roth IRA. If she would have just opened the Roth IRA with all $5,000, she would have never had that penalty. She only opened it with $3,750 though. So guess what? She has to pay a penalty on that difference. So you want to avoid the penalty, make sure the money gets put into, all of the money is put into a new plan. There are a few more plans out there that I just want to discuss before we wrap up, and they deal with self-employed people. All these plans we were talking about, well, the defined contribution and benefits plan, were basically employer sponsored. Individual retirement accounts, anybody can go and open. But what about self-employed people? What are their options? The first one is the simplified employee pension. Okay, and the other one is an individual 401k. The SEP IRA, employee pension IRA. It's an individual retirement account where the owner could put the lesser of $54,000 or 20% of their net Schedule C income minus that deduction they took for the employer portion of self-employment tax. Remember when they deduct 50% of their self-employment tax in that area deduction for adjusted gross income? I'll give you the line number if you're like, what is she talking about? On the 1040, on line 27, self-employed individuals are allowed to take 1/2 of their self-employment taxes as a deduction for AGI. Well, we would subtract that from the Schedule C income, multiply that by 20%. Compare that to $54,000, the contribution is lesser. And you must provide this plan to employees if you have employees in your company. Remember, this is the owners. Dave, 64, receives director compensation of $40,000 during the current year and is reimbursed for all relevant expenses. Due to the specifics of the work arrangement, Dave is treated as self-employed sole proprietor. If Dave sets up a simplified employee pension IRA for himself, what is the maximum contribution he may make to the plan? Well, the overall limitation is $54,000. But then he will take his Schedule C income, which is $40,000, minus 1/2 of his self-employment tax on that $40,000. Remember, we compute self-employment tax by taking the Schedule C income times 92.35%. It's that amount that you will base self-employment tax of 15.3% on. Multiply that by 50%, and that amount is deducted from the $40,000. So the amount would end up being $37,174. Multiply that by 20%. So how much can he contribute? The lesser of $54,000 or that computation, which is $7,435. What if it's an individual 401k? Same kind of limitations, except it's $54,000 or 20% of the Schedule C income minus the deduction, and then add to that $18,000. And it's an additional $6,000 if you're over age 50, which would make your maximum 60. Assume the same facts as Dave, except this time he sets up an individual 401k plan. Again, his self-employment income is all the same. First, the limit on the contribution is $54,000. Really, for Dave, it's $60,000, right? Take $37,174 times 20% and add $18,000 to it. $25,435. If he was under 50, that would be the maximum, but add $6,000 to it. Well, really, if you compare the 54 to the 25,435 would be the amount. Whether it's that amount or the 54, you could add $6,000 to it. So the overall contribution he can make to that plan, $31,435. So those are the major types of retirement plans, how you can contribute to them, and how they are taxed at distribution. The final area of our chapter deals with a special tax credit that is given to encourage middle and low income taxpayers to start saving for their retirement. The credit, in addition to deduction for a contribution. So you get this, it's like double dipping. It's great. It's available to lower income taxpayers. Take a look on page 1331. That defines who's really getting it. If you are a joint filer and your AGI is between 0 and 37,000, head of household 0 and 27,750, all other filers 0 to 18,500. So we're looking at lower AGIs. You could take 50%. 50% of your contribution as a deduction, as a tax credit, as a tax credit. There's our table. If you are, if your income is at these different other levels, then that percentage goes down. If you look at the example below that, Tina earned 24 grand. She earned 4,000 in salary working part-time while she was in school and 20 in salary working for the company. To get an early start on her savings, she contributed $4,000 to a traditional IRA. She doesn't have any other retirement plan. She can deduct $4,000 as an IRA contribution. She contributed it to a traditional IRA and she has no other retirement plan. How much can she claim as a saver's tax credit? Well, the assumption here is Tina is single. Okay. What amount of saver's credit, if any, is Tina allowed to claim, assuming she was a full-time student during only 4 months of the year? So she's not a dependent on someone else's tax return. Well, her contribution is $4,000. Her AGI is between 18,501 and 20,000. So 20%. Just taking a look here. Give me 1 second. Oh, I'm sorry. She cannot base her calculation on all 4,000. The limit is up to $2,000 of contributions qualify for this tax credit. So although she put in 4,000, 2,000 times 20% is her tax credit. What if her AGI is $15,000? 2,000 times 50%. So that's a nice tax credit incentive for taxpayers to save for retirement. So this concludes Chapter 13's discussion. Please post any questions you may have on the discussion board.